Hi guys, I'm Nicola Mackenzie, founder and insurance specialist at DM Mortgages. And in today's video, I'm going to be talking to you about why you might want to consider your life insurance as an income instead of a lump sum, by what we call family income benefit. So I'm not talking about a benefit in the traditional form. Family income benefit is life insurance as an income. So stay tuned to find out more. So guys, before we get into today's video, I want to let you know that here at Dun & McCarthy, we are a team of insurance, mortgage and will specialists. So if you are considering taking out life insurance, then make sure that you get in touch with our team today, because we deal with lots of insurance companies, from the high street options to specialist insurers, to find you the best deal to suit your circumstances. And best of all, our insurance service is completely free of charge. Yes, I did say completely free of charge. So get in touch with us and we can help you sift through the options using our specialist knowledge to find you the best deals. And for every insurance policy that we arrange, we also provide a free will writing service via mylastwill.co.uk. So head over to our website, which is dm.mortgage, and book in today for a free of charge appointment. And of course, if you enjoyed today's video, make sure that you subscribe to the channel and hit the little bell so that you don't miss any of our future uploads. But let's get into it. So let's start by looking at what actually is family income benefit. The abbreviation of family income benefit is FIB. So if I say FIB throughout this video, don't wonder what the hell I'm talking about. I'm talking about family income benefit, okay? Now, the short answer is that family income benefit is life insurance, okay? What it would do is pay out a fixed monthly income when the person insured dies. Now, most people think of life insurance as just a lump sum. A family income benefit is still life insurance, but it's just an alternative way of doing it in the form of an income. Now, ultimately, it's going to give your loved ones regular financial support if you are no longer to be able to provide for them. And that money could be used for anything from childcare costs to paying the bills, to ultimately helping the people you leave behind to maintain a certain lifestyle. Like I said, most people, when they're taking out life insurance, only consider it on a lump sum basis. They're not always aware that FIB, or family income benefit, exists. So it's a really beneficial option to consider. And what we're going to do next is look at the pros and the cons so that we can look at whether it might be right for you. Now, the first pro to having a family income benefit instead of a lump sum when looking at life insurance is that it can be easier for some families to budget using an income. Now, a regular income quite often can make it easier for your loved ones to manage, because it means that they don't have to worry about dealing with vast sums of money, you know, in the way of a lump sum. Now, another advantage, and this is only applicable to family income benefit that's taken out with certain providers. Not all of the insurers will agree to this. Some insurance providers will offer you the choice at the point of claim to be able to take the money as either a lump sum or a monthly income, or, well, for your beneficiaries to be able to take the money as a lump sum or as an income. So for example, let's say that you've got 2 years left on a policy. You may be able to take it as a lump sum rather than a monthly benefit. So let's say that you're insured for £2,000 a month. You die, your beneficiaries make a claim, and if they're offered to take it as a lump sum or monthly, then they would take the lump sum as £48,000, because that's £2,000 a month times by 24 months, 48,000. So that makes the option of a family income benefit just that little bit more flexible. Now, the other advantage of a family income benefit policy is that it can be a cheaper alternative to a lump sum, or you might be able to get more cover than the equivalent lump sum option for the same price. Now, let me explain what I mean, and it will make a bit more sense. It's particularly useful if you're looking at large amounts of cover. Now, let's say that you've got young children or dependents. It might mean that they need more money whilst they're younger than they do as they get older. So family income benefit can be very useful in those scenarios. Now let's look at a specific example of what I mean by this. So this example I have based on a 31-year-old healthy non-smoker. Let's say that they were considering taking out family income benefit to pay out £60,000 per year, so £5,000 a month, over a 20-year term. Now, if that person died immediately after taking the policy out, then that policy has the potential to pay out £1.2 million. The cost of that cover would work out to approximately £21 a month. Now, if that same person was to take out a lump sum, a fixed policy, what we call a level policy of £1.2 million, so level meaning that the amount of cover stays fixed throughout the term of the policy over 20 years, instead of £21 a month, that same policy would cost in the region of £31 per month. So you're talking 50% or thereabouts more per month for what could potentially pay out the same amounts. Or let's say that same person was happy paying around the £31 a month figure, but still just preferred an income-based policy. Well, actually, instead of £60,000 per year, that policy would pay out £90,000 per year. So again, if we look at the total payout over the term of that 20 years, that policy could have the potential to pay out £1.8 million if that person died shortly after taking out the policy, compared to if they took that policy out as a fixed lump sum, which would work out to £1.2 million worth of cover. So in other words, that could potentially be an additional £600,000 worth of an income that that person's family would have to help to deal with the loss financially of that person. So based on circumstances, guys, this video isn't about one option being better than the other. You know, it just doesn't work like that. It's just that an income is better suited for some people. Generally speaking, if you have younger children that are going to be dependent on you for a long time, they're quite likely to need a lot more financial support when they are younger and less support as they get older. And therefore, a family income benefit policy is a very good option to consider. But with all that said, depending on your individual circumstances, it still might be that a fixed lump sum is the best option for you. So it's about getting in touch with us. We can look at the pros and cons with you. We can look at the different options with you, compare to see what's best suited. And the next advantage to a FIB policy, family income benefit, is that just like life insurance as a lump sum, you can put your policy into trust. So the benefits of putting a policy into trust, I also do have a video on this, so make sure that you check that video out if you're unsure on what a trust can do to benefit you. But ultimately, a really quick summary, it means that in the event of a death, the policy proceeds under the life insurance would pay outside of what's called your estate. So what that would mean to your beneficiaries is that it can mitigate an inheritance tax bill. And it also means that the money wouldn't get caught up in probate, and that can save a lot of time. So your family get the proceeds much quicker, often within days instead of months. Now let's talk about some of the cons. Not all insurers offer family income benefit policies. Now you will find that there are lots of insurers that do, but there are some that don't. But of course, that's where we as the experts come into it, so we can help you to navigate through the options to find out which providers are offering it and make sure that the providers that are offering it, we're looking at the best quality options. Now the next con, depending on which way you look at it, is that if you die later in the term of the policy, there would be less money to pay out. So let me break that down and explain that to you. When you take out a family income benefit policy, you have the flexibility to choose how long the policy runs for and how much the monthly income is. Now, using my earlier example, so let's say that I take out a policy to pay out £5,000 every month for 20 years. If I die when there's 2 years left to run of that policy, so 18 years in, then that's potentially a payout of at most £120,000. Because £5,000 on a monthly basis times 24 months equals 120,000. If I'd have died a week into setting that policy up, so very early on, then that policy would have potentially paid out £1.2 million. So it's a decreasing type of policy. Now, like I said, that is a con depending on which way you look at it. Again, when you take out insurance, it's about what is the reason I'm taking this insurance out. If I've got children, like I said, and my child is 1 year old when I take that policy out, that £1.2 million is going to be very useful. When that child gets to 21 years old, am I going to need £1.2 million? Perhaps not. So that's why I say it's all about individual circumstances. Now let's look at who should consider a family income benefit policy. Usually it's designed for people that have dependents, so whether that's children, a spouse, that's generally who would benefit most from this type of policy. So if you want to cover your own financial commitments to provide for your dependents, then a monthly income can make things a lot easier for them. Now, just expanding on that, it's particularly useful, as I already hinted earlier on, for those who have dependents where the financial dependency is going to reduce over the years. Now, how much does family income benefit cost? Now, obviously that's going to depend on so many different factors. And again, we would work with you when you're booking for an appointment to look at an option that is tailored to your specific budget. But generally speaking, it's going to be based on how much you're insured for, how long you run the cover for, your age, your health, whether or not you smoke, the quality of the cover. All of these things are going to be factored in when determining the cost. But like I say, it's generally a more affordable type of insurance compared to alternative options. Now, as I highlighted earlier with that scenario that we looked at, the premiums tend to be lower than if you were to take out the equivalent amount of cover as a lump sum, because essentially the amount of cover is reducing over the years. Therefore, the risk to the insurer is also reducing over time. So it's a really good alternative to consider, and a competitive one as well. So make sure that you head over to our website and book in for a free of charge appointment, because our team are fully qualified specialists that can help you weigh up all of the options, look at your situation and make a recommendation on what is best for you. And like I said, we're dealing with high street insurers to specialist insurers, comparing lots of different options to find the most comprehensive and cost-effective solution to meet the needs of you and your family, to give you the right financial protection. Now, also, as I mentioned earlier, with any insurance policies we arrange for our clients, we would put the policy into trust at no extra cost to make sure it's tax efficient and your beneficiaries can claim the payout much quicker. And we provide a free will writing service via mylastwill.co.uk. And best of all, the service is free. So head over to the website and book in today for an appointment. And of course, if that video has been useful, which I'm assuming it has, as you've stuck around this long, then make sure that you subscribe to the channel and hit the notification bell so that you always know when I upload in future. And I'll look forward to seeing you in my next video. Until then, take care.